Okay, let's answer some questions. What do we got? Meldrum the madman shorted Tesla. He shorted an actual cult. That's a good way to describe it, a cult. Yes, I did, with a short risk reversal. And this morning, news hit that they're being investigated potentially for securities and wire fraud. Not good. We don't see the stag in inflation. Nice phrase. Not mine, unfortunately. That was Powell's. You mentioned that your prediction in the video is 90% right. If you look at your portfolio returns from the last 10 to 20 years, and how many years have you outperformed SP 500? Pretty much all of them. Not 100%, but year to year, it's not hard because I could invest outside of the index, so it's not a fair comparison. When you ask somebody if they beat an index, the fairest comparison is that individual is restricted to only investing in that index. So they have to pick winners, overweight winners, underweight losers, to determine whether or not their skills were better than a passive strategy. Well, the S&P 500 is not a passive strategy for me. You can always beat the index by just taking on more risk than the index, right? So because I don't restrict myself to any one asset class or any one index, I'm more like a hedge fund than a mutual fund. A mutual fund or a larger investment fund would have relative performance. I would grade myself on absolute performance. So my appropriate benchmark is a risk-free rate plus, let's say, 800 basis points. So 13.5% would be my benchmark, regardless of what the market did. So even if the market went down, it's not enough to say that I lost less than the S&P. I really should have positive performance in all environments. Uploading these in podcast format. Sorry about my chair, but it just squeaks in podcast format. It seems like it would be high ROI as you already make these. Well, I don't monetize them, so there would be no ROI. Plus, almost everything I do is visual. Let me see if I can get my chair in a position where it won't squeak here. If you think the Fed has to cut rates and nothing in the market breaks in the meantime, isn't this a bullish setup for the market? It is a bullish setup if you think that, but the market doesn't think that. Otherwise, there would be more rate cuts priced in, and there isn't. So the market doesn't think it is, so the market will respond as if it's not the case, which means it's going to be challenging retaking those highs and moving higher. What do you like about ABR earnings? So you decided to add shares. They beat the estimate of what they were expected to do. They did lose money on some loans, which is expected, but they had already reserved for it. So their losses aren't greater than their reserves. Overall, it was, given the environment that they're in, you would have expected them to do much worse, and they didn't. This is the worst environment for them. High interest rate and difficulty in the commercial real estate field, especially in multifamily, and look at where they are. And after the market close on Wednesday, they did put out a statement getting ahead of all the short sellers, saying, listen, we know that there are short sellers out there, and we're probably going to hear more about them. So let me just, they came out and said, let us just say this right here and now, which is a bold move. 29.55. You said before, when we look at debt levels, we should also consider GDP. True. If our interest expense triples, do you see our GDP growth increase enough to cover the interest expense? Well, I can answer that two ways. Is it enough to cover the interest expense? Sure. Is it enough to cover the interest expense and everything else the government wants to do? No, we know that because they're running deficits, and it's deficits as far as the eye can see. So any increase in interest expense from here on in will simply just pile on to the debt, add to the deficit and pile on to the debt. The interest expense this year is expected to be $1 trillion. So there is going to be a $1 trillion increase in the debt. Now put your deficit on top of that, right? So it is, I think, at a point where you've got to look at it and say, this is not a warning anymore. This is you're nearing a crisis, and I could say that it probably will end up being a crisis at some point, because I do not see on the horizon any political will for a balanced budget. There's not even a discussion of a balanced budget. So, you'd look at debt to GDP, and then you would look at interest expense as a percentage of federal spending. ABR is navigating tough environment. Can you talk a little about? I just did that. Utilities outperform next 3 to 5 years due to the build out. If you consider the utility construction engineering companies are contracted to build the infrastructure. Companies not subject to the same regulations as utilities. That's true, which is a double-edged sword, right? They're not subject to the same regulations, so they can make as much as they want. They can also lose as much as they want. The utilities' assets are going to increase. They have a regulatory return, which means their dollar amount of return is going to increase for the same amount of shares. Well, I shouldn't say the same amount of shares. Utilities are known for issuing shares. But usually the dividend will increase in line with the growth in regulatory assets. So the difference between a company that's building it for them and them building it themselves is that, I shouldn't say them building themselves, but a company building it for them versus them having the assets, is their return is tied to the level of assets. The company building it is not guaranteed a positive return. They can lose money. What do you mean when you say once the 35 billion market MBS has exceeded any excess added to treasuries? So let's say that 40 billion of principal runs off on MBS in a month. The cap is 35 billion. 5 billion would go into U.S. treasuries. That's what I mean. Once the 35 billion is exceeded, will the Fed start buying MBS? Well, it already has bought MBS. It wants to get rid of them, so they will not start buying MBS. No. When will you be uploading in the applied series positions? This fall. I like to analyze your positions and see the themes behind them this fall. What's your opinion on mass layoffs, both from a philosophical, humanitarian, and economical perspective? I don't know that it's worth getting into a philosophical or a humanitarian debate on this. You can make the case both ways, and I can make the case both ways. I don't know which one I really believe in. And I could say one thing and somebody else can say another thing, and we will never convince each other, ever. It's rare that you change somebody's mind on issues like that. They have to come to themselves. So I find that these debates are, other than an intellectual challenge to see how you can trap the other person in their own words and feel good about it, you're never going to change their mind. From an economic perspective, it is optimal, because a company that is not doing very well, that's holding on to resources, may raise the cost of those resources to another firm that could do better. So with layoffs, it releases resources, and humans are resources, releases resources back into the economy for other companies to take. So Tesla just got rid of its whole supercharger team. Well, great. Another company that is looking or that's playing in that space may look at it and say, well, there's a whole bunch of knowledge in that supercharger team. Why don't we hire them? Right? So it actually is a good thing. From an economic perspective, it is seen as optimal, because resources will then be directed to better and higher uses. Do you have a good resource that shows the percentage of interest expense on government debt to GDP? Treasury.gov. Click on the data tab, and there's a whole bunch of subtitles there that you can click on. Seen you reading poetry a couple of times. What poet do you suggest a beginner to get into, and how to develop the art of appreciating poetry? I don't know that you would get into a single poet. I think you would probably do more of a survey of a number of different poets to see which style you like the best, which style appeals to you. But if you're new to poetry, you're going to need a guide, because you're not going to know how to appreciate it, what's important, how to evaluate the structure. Plus, if you're younger, poetry sometimes eludes you. because poetry is an exploration of the human condition, or at least the more interesting ones explore the human condition. I find the most interesting art and the most interesting literature does the same thing, right? I'm not big on reading science fiction novels. I don't think that you get much out of it other than a cool story, although I like science fiction movies for the special effects. But I think that you have to come to poetry later in life to really appreciate the messages in there, to find meaning in there, because now you can tie it to something in your life. There's something that you recognize. There's something in there. But I think you would probably find a good channel on YouTube. There are lots of good English teachers on YouTube that have their own channel, that are poetry teachers, that will go through a number of different poems. There's all the poems are available free online, because most of the good ones were written long before copyright still applies. So find a good channel on YouTube in that realm, and from that, YouTube will begin to suggest other channels that are like that, and just begin your exploration. Been watching your videos but don't recall seeing anything on short squeeze. Can you please help how to interpret indicators like short interest, percent of float? Wow, that's nothing I can do in an answer really quickly. It's I'd say the easiest way to think about it is the higher the short interest, the more likely you are to get a short squeeze. Can you provide the source of data for the study at 820? I don't know that I presented a study. I don't doubt the numbers, but I'm wondering if any mention of the cause or type of debt was investigated. Oh, okay, I know what you're referring to now. For instance, was it discretionary or non-discretionary? Who cares? Who cares if it was? Who cares how the debt came about? The only thing that matters when you have to pay it back is that you have debt to pay back. I don't think the source of the funds cares. If you say, well, this was discretionary, I don't have to pay it back. Doesn't matter how you got the debt, you got to pay it back. So if we're looking at the distribution of debt, I find that a lot of people like to talk about the distribution of wealth, but they never want to talk about the distribution of income and the distribution of debt, because it is that distribution that combines to create the distribution of wealth. So let's think about it in deciles: first, second, third, 4, 5, 6, and 10 being the upper 10%. And if we're looking at the distribution of debt, it's not a matter of who holds the most debt. Usually you're looking at debt to income or debt to assets. So let's think about debt to assets. The bottom decile, and I'm going to use a particular type of graph that's common in this, which is this type of graph, box and whisker plot, but on a horizontal. 25th percentile, 75th percentile, and these are, that is the full range of the data, with this being the median. So we get that. This is the 25th percentile, that's the 75th percentile. If we look at the bottom, the plots tend to look like this, right? As you move to the top, they narrow a lot, and they look like this. The range narrows a lot, so that the median tends to follow this type of process, and the range gets smaller. As you go up through the deciles, the range gets smaller and the median gets lower. This is saying that the bottom 10% sometimes has negative assets because the debt overwhelms the assets. And it's not, we can't interpret it as, well, the bottom 10% has the greatest debt burden, those poor people at the bottom. That's typically, in a system like the US or Canada, typically not how it happens. Is that somebody in the 7th or 6th decile starts taking on more debt, and they end up at the bottom 10%. If we look at debt to income, you'll have the same type of distribution, but it's not so prevalent. Reason you have this down here, you have people without almost any debt here, is because if you are in the bottom, it's very unlikely you're going to be able to get any kind of debt whatsoever. So if we think about it, the bottom 50% in terms of the debt burden, their debt to assets, significant. Somebody up here may have more dollar debt than somebody down here, but they have significantly more assets. They're in the top 10% and they've managed debt in a reasonable way. So this is a common pattern you'll see, whether you're looking at debt to income or debt to assets, is the burden of debt in their lives is greater for those under 50%. So there's one side of the argument. The interest expense on this really is non-negotiable. You're going to pay that interest. You can't really shop around. Depending on your credit rating, you have a certain interest that you got to pay. If we go to CPI, there's CPI-U, which is the CPI we pay attention to. There's another one called CPI-U. This is all urban consumers. This is chained, which means it accounts for substitutes. So if you go to table 5, I believe it's table 5 in the CPI report, there are 4 columns. The last 2 columns, this column here is CPI, this column over here is chained CPI, and you'll have like March 24 and its last 2 years by month. Have a look at the CPI. Let's say it's 3.5. You'll notice the chain is like 3.1. Next will be like say 4.0. You'll see 3.4. The chained will come in lower than CPI. The chained accounts for the substitution that consumers can make. So we do have evidence that consumers can in fact beat the CPI. They have choices. They can use those choices to beat the CPI, but they cannot choose to beat their interest rate. It is what it is on their debt. So what we're doing when we raise the interest rate for those people in the bottom 50% is saying we're going to give you something that you can't avoid to help you lower the price on something you can avoid, right? And that's what's going on down here right now. Is you're killing them because they're doing the best they can to lower their cost of living, and you're raising interest rate on debt. And debt as a percentage of their income or debt as a percentage of their assets is significant. Much more so than the top 5 deciles, let's say. So you're not really doing them any favors. You're not doing what you're saying. You're saying, well, we know that it hurts everyone, and we're going to crush inflation. And we're going to crush inflation by substituting something you have a choice with something you have no choice with. Doesn't sound like a good trade-off, does it? You can Google debt to income distribution in the U.S., debt to income distribution in whatever country you're in, and debt to assets distribution as well. You stated that the Fed interest rate decisions largely affect only money market rates, while capital market rates are predominantly affected by GDP growth. I'm confused because the jobs report came out last Friday. Oh, I see where you're going with that. Okay, I can explain that. Let's get a yield curve up and let's break it into 2 sections. Here is our money market rates, our 1 month, 2 month, 3 month, 4 month, 6 and 1 year. We'll say that's the 1 year. And then the 2 year usually comes in a little lower, and then you have your capital market curve. The 2 year really doesn't bring in much in terms of GDP and expected inflation. It's as close to a forecast for the Fed funds futures you're going to get. It tends to lead the Fed funds futures pretty consistently over time. So the market's pretty effective at pricing the 2 year such that it leads the Fed funds futures by a number of quarters. But once you get to the 10 year, that's not really in here. So we had lower jobs numbers, so the expectation is probably lower GDP, and with that comes lower inflation expectations. Downward, right? Quarterly productivity readings are not as positive as the Fed would have liked. Or businesses, or consumers, or anybody, really. The year-on-year number is slightly highly correlated with the CPI inflation rate and is now down to 1.8%. Well, why would you want productivity to be down? Why would you want it to be down? You see an overlay of the series in your dealing charts. How much weight do you give to the longer arc numbers? Well, yeah, but quarter to quarter they can be noisy. I have no problem looking at year over year. Oh, this is a long one. I don't know if I'll read it all. Curious on your thoughts on the slight changes to the FOMC statement, specific sentence around confidence. Am I crazy to think the FOMC has subtly meta-communicated something important? Yeah, I'll stop right there. Yeah, you're trying to double guess what the Fed is saying and thinking that maybe there's some cryptic message in there for the market. There's not. They say what they mean. That's it. There's no cryptic messages in there. They're not trying to subtly hint to somebody anything. You just read it for what it is. If they say we don't have confidence, what translation is we don't have confidence. Period. There's no cryptic messages in there. There's no idea of meta communicating anything. It just is what it is. That's it. So yeah, I think you can go down rabbit holes by second guessing and triple guessing and saying, oh, hang on a second. Based on what the Fed says, if you look at a map and you draw a line straight north, you'll get to a city called this, and then if you go south, that's this, and this means that they're bullish, or that they're hawkish because this is called Hawks Point. Oh my God! Oh my, no. There's nothing. Just take it for what it says. The sentence is the sentence. Period. Think of it as written by a 5-year-old that doesn't even understand what messaging means. Confidence technically isn't there to cut. Period. And the Fed is adamant about 2%. Period. If CPI isn't down significantly on May, we now have a few months sequence of bumps, which really aren't bumps anymore. Well, careful. CPI did drop, and quite a bit from February to March. February came in at 0.4 on the headline. March came in at 0.4 on the headline. And you're thinking, how is that a drop? It's the same thing. You have to go to the adjusted indexes, which you only get in the database. It's not in the CPI release. And if you calculate the month over month on the adjusted databases, this was 0.442, and it's rounded down to 0.4. This was 0.378, and it's rounded up to 0.4, thereby giving you the impression that nothing changed month over month, but it went from 0.442 down to 0.378. There is information in that second and third decimal place. I don't know why they don't print it. But 0.4 to 0.4. But it did drop, 0.442 to 0.378. So, we have to pay attention to the other decimal places because 0.351 is 0.4. 0.449 is 0.4. But there's a big difference between 0.449 and 0.351. So one decimal place on a big important number, I don't trust that. Especially a statistically derived number, I want to see it myself. The other thing you can do is you can look at each individual item. You can download this in a spreadsheet and automate this. Look at each individual item. It'll give you the month over month, 0.12, let's say. And then it gives you the standard error. Let's say it's 0.07. 2 times the standard error is 0.14. So that would be 0.26 to negative 0.02. It contains 0. This column that would be in the middle here is the contribution to CPI. You can make it 0. You can go through your spreadsheet and make it 0. Anything that's not statistically different than 0, make it 0. And then you add up this column and you see what you get in terms of the month over month. CPI, you'll find it can be quite low because a lot of the entries are not statistically different than 0 when you consider the standard error. So they may have a lot of that analysis done for them, whereas most people would never know to do that analysis or would never carry their analysis that far. They'd look at the 0.4 to 0.4 and react in the market, when really it's 0.442 and 0.378 on headline. Well, that's a big change. What if this were just a little bit higher at 0.451? Let me write it again. If this were just a little higher at 0.451 and this were 0.349, then you would have 0.5 and a drop to 0.3, right? And I really only pushed this a little bit in each direction, but look at the big difference that you would have gotten. So I think we can, what else do we have here? Line there, repricing to higher yields would take effect to new highs if that were the case. April 30th, commitment of traders report, we have the most short ZT since February 20 and a near full unwind. Well, let's be careful there. The 2-year is also one leg in a curve steepener, curve flattener trade. So it's hard to say, well, you know, what's going on with the 2-year. It has the most. You would have to short more 2-year if you're long a 10-year for a steepener, let's say. You would have to short more. For a flattener, you would have to short more. So it would appear that there's more short position on the 2-year. So, you know, you can't just look at one position and say, aha, everyone's short. Well, it could be part of a larger trade. It could be part of an immunization strategy. It could be part of a hedging strategy. It could be part of a curve steepener, curve flattener strategy. You don't know. You know, we can read those reports, but we got to be careful because we don't know exactly how they came to be. VRE and equivalent holding review. I've answered this I don't know how many times now. So I'm going to pass on that. Somebody's just not watching the answer video, but are they persistent asking their question? Being that it's been asked for quite some time now, I would say Google it. I mean, you don't have to wait for me. Just Google it. Look at the holdings. Figure it out. U.S. debt portion, when you compare the value of debt and interest rate, wouldn't it be more accurate if we adjust the debt levels with the... No, you don't adjust for inflation. You don't adjust for inflation. What you would do is if you have a nominal number, you divide it by another nominal number. You look at it in relation to something else, nominal over nominal. The inflation components cancel out. And then you're left with a number that is not related to inflation. So like debt to GDP. Saw a presentation done by Advent Capital Management, showed a portfolio of 100% convertible debt outperformed 60-40 allocation 98 to 2023. What are your thoughts on using convertible debt as your fixed income allocation given their asymmetric return profile, especially now the coupons will be higher on new issues? Oh, careful. No, they won't. Convertible debt usually has zero interest rate or like basis points in terms of interest rates. A big coupon on a convertible debt might be 0.5%. You're not getting anything because you're getting a call option for free. And the higher the interest rate, the higher the price of the call option. So basically the call option squeezes out all your coupon. A convertible debt is equivalent to buying a whole bunch of calls, buying $1,000 worth of calls, and if the calls don't work out, you get your premium back, you get your $1,000 back. That's what a convertible bond is equivalent to. Is if I bought $1,000 worth of call options, and in 4 years, if those call options didn't work out, I would simply just get my $1,000 back. So I would lose purchasing power on that $1,000 over time because it doesn't pay. It usually has a 0% interest rate or almost a 0% interest rate on that. I'm getting the call option for free. I find it interesting that they didn't say, how come they didn't say from 1997 to 2003? Why not 1996 to 2003? Why not 1980 to 2023? Like it seems like they've done their analysis and then they pick just the period of time over which it outperformed. Why not some other period of time? Be careful about these. Why not since inception? Right? The indexes have been around longer than that. Why pick 98? You know, it's like if I said to you, look, I found this thing. I mean, between 2011 and 2019, it outperformed. Yeah, but what about all the other time periods? Right? Anything can outperform over a period of time for no other reason than statistically it did, or empirically it did, but that there is no reason that it did do it. It just sometimes it does. Would you have ever been interested in working in the Treasury Department of a company? When I was a kid, it's not something I said. When asked, what do you want to be when you grow up? It was not on the top of my list. But I think, no matter what job you would have put me in, I would have found a way to find it interesting, except HR. Or if I was in the ethics department of a company in terms of issuing guidance, I think both of those, I'd probably be going to work with a thermos of orange juice and vodka. I don't know that I could find any of those interesting. Do you ever tune into the annual Milken Institute Global Conference? Sometimes, but it's not on my daytime or no. What does increase or decrease beta exposure mean? Increased beta means you're buying more equities. You're buying more of some asset that has market exposure. Decreasing is the opposite. If I have stocks in the portfolio with all beta greater than 1, and I'm expecting market to go down, how to reduce beta? You can sell calls on your holdings. Selling calls will give you negative beta. You can short futures without having to sell any of your holdings, or you can sell your holdings and move into lower beta stocks. Completed FRM Part 2 last year in August. Really like factor risks in investing. It really intrigued me. Chose CFA 1, want to get more deep into the field. What steps would you recommend I take to better myself in the same and in the, well, you're doing it. What steps would I recommend? Do what you do. You already have identified something. You've been through FRM. You've decided to head over to CFA, and you're probably, doing your own work on that space, reading what you can. So you're already doing it. Willing to share some of the tax rules that you have learned over the last month. Where would I start? I have learned that sometimes it's better to invest in a business as an angel investor for tax purposes than it is to give to charity. I mean, that was an obvious one. It was like, well, under these conditions, why would I ever give to a charity? I give to a charity, the money's just gone. But if I give to this business, I get a better tax break. If it's engaged in certain things, I get a better tax break. And this just may hit. Not only that, it may grow to employ hundreds of people. Isn't that a better outcome for society than giving to charity? You look at the investment tax credits and you say, well, this makes sense. The role of depreciation on a second property is absolutely huge in bringing you down to, well, if I were in Canada, 53.5% tax rate, I could work it effectively to get to a 20.5% tax rate, which would, after provincial and municipal, put me around 33%. It's still 20 points down, but I can get my tax rate down 20 points with something like that. So even if your goal in real estate for that, as I look at it, I think, well, my goal is to run cash flow even and net income negative. In the first 5 years, your depreciation tax shield will overwhelm the income that you make. You're not trying to build an empire. You're just trying to shield your income. So as long as you're cash flow neutral, your non-cash expenses, who cares? And if you really want to have a nice depreciation or a nice tax shield, lever it up for whatever you can get. As long as you're cash flow neutral, and you only have to be cash flow neutral on the interest. The principal you can think of as a contribution to your portfolio. There's a lot that if I couldn't get out of Canada, if I had to stay there, there's a lot that I can do to lower the tax rate that I would have to pay. Now, at some point, you got to pay the piper, but you can delay it for a long period of time. You can run at the minimum tax that you have to pay. A whole bunch of things. When I asked, I remember having meetings with two big accounting firms when I had my business, saying, look at my taxes that I'm paying each year. Look at them. You guys are the experts. What can I do? And they didn't offer very much. They said, it looks like the tax rates are the tax rates. Like, but you guys are the experts here, man. Like, shouldn't you tell me don't make any more charitable donations? These are the types of businesses that you want to invest in. Also, in your own business, I see what you're trying to do. Have you ever thought of trying to do this? This would qualify under research. It would offer you a competitive advantage if it worked out, and you would get some tax credits for this kind of stuff. Well, aren't you guys supposed to be telling me this stuff? I mean, I could have significantly reduced my tax burden in those years, and the more cash you can keep in your company, the better it is, right? I just find that experts today simply means I know something that you don't know yet. That's all an expert is. But that if you knew it, you'd know it better than them. Keep in mind, most people you bump into are average. Most that you bump into. So a tax specialist is just somebody that learned about tax, but you didn't. Of course they're going to know things you don't know because you didn't learn it. But if you're above average in ability and you learn it, you'll know it better than them. Most people are average. And I'm unfortunately seeing that. Well, I've always kind of known it, but you expect that if you're with a large firm and you're called a tax expert, you are an expert. Not somebody who is knowledgeable about tax because I took some courses and read some books that you didn't. If somebody's an expert, I want them to be an expert. I want them to say, here's what we can do. Here's 15 strategies we can deploy right away. But don't have that. How do you see that the Fed was always hitting its treasury cap of 60 billion? Well, you can go to the New York Fed, and if you're looking, just Google SOMA New York Fed, and you'll get this up. It comes in like a little box in one tab here. We'll give you the monthly listings, and it gives you a listing, let's say, of the month of May, and it gives you the value of everything that's maturing that month, so you can add it up. You get to 97, you say, well, this month 97 is coming due. The cap is 60, so I know they're going to reinvest 37. Distinction between wealth management and savings management. Is that the threshold in line with Charlie Munger's 100,000 threshold? Well, that's not really his, right? It's sort of industry and wealth management. It's sort of recognized. I think mass affluent is somewhere up to 250,000 or 250 to a million or something like that. But there is that 100,000. It's 100,000 and up is sort of like an entry cutoff point into wealth management. After that, below 100,000, I don't know that would say that you have wealth. You got some savings, but I don't know that there are lots of wealth managers that have minimums, so that your minimum is 250,000. As far as I remember, you mentioned a few times the U.S. debt ballooning could be a big global problem. However, in case U.S. real GDP growth will be sound and sustainable, U.S. will be keeping its economic leadership and somehow resolve its fiscal issues. Do you still see the ever-growing U.S. debt? Well, basically what you've done is you've told me to assume that they're going to solve the problem, then ask me if I see a problem. So you're saying assume that GDP growth is good. The U.S. keeps its economic leadership and somehow resolves its fiscal issues. Is the debt a problem? Well, you've just given me the scenario where the debt is not a problem, and then asked me if it's going to be a problem. So the problem is not that there's no money. The problem is not that tax revenue isn't there. It's a spending problem. And the problem with the spending is that neither side, in almost any democratic country, no party sees it as a problem. Which is the problem? Deficits as far as the eye can see. Now, if there's going to be a change, that has to change. Is that there has to be a focus and a big discussion and momentum behind the idea of balanced budgets. Balanced budgets, debt repayment. Balanced budgets, debt repayment. I don't hear any of those two terms being bandied about anywhere at all. So it is a problem because they don't see it as a problem. So yeah, it won't be solved until it is a crisis. There's a conflict of US, EU, UA. I don't know what UA is, versus Russia. Hence, the West imposed trade and financial sanctions against Russia, which led to some decrease of U.S. euro share usage in global trade, mainly in favor of yuan, the rupee. If the countries will continue to develop usage of non-various U.S. currencies, do you see the real danger to U.S. strong global positioning? No, because you have $100,000 today and you need to put it somewhere safe. Your choices are lend it to the U.S. government, lend it to the Russian government, lend it to the Chinese government, lend it to the Indian government. Which one? Quick, choose now. You said U.S. I know you did. Until that answer changes, the answer to your question is no. It's not a threat against the attractiveness of U.S. debt. I don't see a time where you would pick lending money to the Russian government over any other government. So get rid of that. Do you see a time where you would decide to lend money to the Chinese government over lending money to the U.S. government? I mean, realistically, you can probably say no to that. And maybe India? I don't know. Instead of looking at average interest cost and debt level, don't we have a metric for interest cost in dollars? You do. Treasury.gov will take care of that for you. I gotta open this app. So otherwise, if I don't, it dings twice to tell me, hey, you have a message. You just passed level 3 in February 29. This seems familiar. 4 years work experience portfolio. What would be your next steps? Well, I got 4 years work experience. My next steps would be show up for work the next day, I guess. I don't know. Being that you're asking that question, it seems that you're unsatisfied with where you are. So the first thing that I think that you would have to do is determine what it is that you want, what's important to you, and then decide what you would do. Somebody who's satisfied in their position would not ask, what is my next step? Onwards and upwards. That would, whatever that looks like to you, would be the next step. Non-farm figures sound as if they were more relevant when subsistence. Why go back 500 years? Or similar was more common in the U.S. There was no such thing as jobs reports when subsistence agriculture was common. Does the inclusion of farm figures in the economy still skew the data enough for it to just... Well, yeah, it does. You have to harvest everything. And that is you usually have large hirings around certain times of year. And the harvest season in the U.S., if you go from the southern border to the northern border and back down, you start at the southern border, and the harvest season rolls on up as the summer progresses into fall. So it would, because you have a lot of migrant workers. Now, here's the thing. Those workers are not correlated with economic activity at all. They're correlated with the health of the harvest. Whether it's recession or expansion, you still got to harvest that wheat. So it would dampen the signal you get from the real economy. Call on Tesla. Good idea going short. Too scary for my blood. It is a tough one to short. What financial ratios are most important when doing fundamental analysis? You tell me what industry, I'll tell you what ratios. I know you don't really focus on that, instead seeing if they have a good story, but I'm interested in hearing any particular ratios they should pay attention to. All of them and none of them. It depends. It really depends on the industry. It depends on the type of balance sheet the company has. Is it heavy with fixed assets like auto manufacturers? Is it asset light like software developers? Is it purely financial like mortgage REITs? Different. Each of those balance sheets will require different, you'll be looking at different types of ratios. So, there's no one answer for that. You tell me what you're looking at, and I'll tell you as best I can the 3 or 4 big metrics that would be important. Have you given in yet on getting your lower prices for cap? I didn't get them all. Unfortunately, I got greedy. I wanted low 42s, even in the 41s. I got greedy. Didn't get them all. Interrent still yet to hit 1150. I bought 2,000 at 1190, and I was going to buy every 10 cents down. I was going to add 2,000 every 10 cents down. So I put a bid in at 11.90, got it filled. Put a bid in at 11.80, did not get it filled. Killam early this morning, put a bid in at 16.90, did not get them filled. So Goodyear Tire, I'm looking at getting a bid in under 12, and it did that this morning from 12.40 down to, I saw it print 11. I got excited. Okay, here we go. Let's take an initial position in Goodyear, and then it just rallied back up to 12.40. So that happens to me a lot these days. So I'm sort of thinking, you know, I got to get more aggressive in getting in and not worry too much about, you know, trying to pick the prices. Retail Investor Canada, use RBC. It sucks for analysis and reporting. Do you still recommend Coifin? There is an open source Bloomberg out there. Well, a Bloomberg kind of replication. It's open source. I forget what it's called. I could never get it to work on my Mac. Never. But people use it. Just Google open source Bloomberg replica, and I'm sure you'll find it. Killam's average portfolio is 28, CapREIT above 30. By the way, CapREIT reported after the bell today, and all the metrics look good. This means they're holding a lot of Class 3. Not necessarily. Not necessarily. You could have a 30-year-old building that you've upgraded significantly into a Class B or a Class A property. Besides, if I'm looking for potential, let's say you have a Class C property and a Class A. The Class C is 50% occupied, and the units can be upgraded, whereas the Class A property is mint. It's mint and it's 100% occupied. Well, you will pay for that, and where's my growth? My growth only comes from rents. Whereas from this one, where's my growth coming from? My growth comes from the ROI in each unit. As I turn over each unit, I can get higher rent on that. It comes from getting rid of some of these people who probably aren't very good tenants, up-tenanting, and increasing my occupancy from 50 to 100%. So I have a lot more growth potential in a C building and a better return on investment because I'm not going to pay a lot for it than I do on an A building. Right? My return on the A building will be lower. Short on ES at 52. I also added at 52.80. What other option would you recommend to hedge downside risk? Sell calls on positions you have if you feel that upside is limited. Can you recommend some ETF? Well, I don't think you need an ETF. You mentioned that your conviction on TLT short put is based on the fact that sooner or later the Fed will have to step in and drop interest rates. Most likely by both cutting the Fed funds at the front and reinvesting QE at the back. Well, they're already doing that. I agree with this analysis. However, I wonder whether there might be a more convex expression to this ultra-long duration sentiment. Yeah, just buy bonds. You can buy bonds that have the same duration as TLT. Just buy a treasury with a duration of 16. Actually, buy one with a duration of 17. Buy a bond with a duration of 17. You'll get more convexity and you'll have a higher yield. About 100 basis points on that. Such as, for example, tech, biotech. Well, biotech is uncorrelated. You really got to know what you're doing here. Private equity. Well, what you're trying to do is say, well, instead of TLT, let me get something else. I mean, maybe something else will work, maybe it won't. I don't know. Maybe it will, maybe it won't. But bonds will do better than TLT. This other stuff, I don't know. Maybe. Maybe it will. Maybe it'll crash and you'll lose a lot, right? Maybe it, I don't know. Beats me. I don't know how you would assess private equity on that one. What about potential rate cuts in your SPY bearish beta exposure? Remember you mentioned that with rate cuts you'd immediately close your bearish. Well, the trade is based on the market does not think there will be rate cuts. So it's the market that will respond to that. I think there will. But just because I think there will doesn't mean the market goes, oh, Meldrum thinks there will, we're good to go. The market only thinks, two rate cuts. With who spoke today? Somebody spoke today and said that it's going to be that we're going to be here for quite some time. I forget who it was, but it doesn't look. It doesn't. If we take them at their word, it doesn't look good. I don't think that the FOMC doesn't believe what they're saying. I think they believe what they're saying. I just don't think they've come around to the conclusion that they really have no choice. They're going to have no choice. I didn't see SPY giving much pullback from 6 rate cuts in December, transitioning to 1. Yeah, that's the point. As you go from 6 to 1, the market appears to be, even at the same multiple, seems to be more and more expensive because the catalyst is disappearing. Why you don't want currency risk in your TFSA? Well, I don't think you really want a lot of risk in your TFSA. It's tax-free, including your losses. Your losses can't help you. Money went into your TFSA after tax. And if you lose money, oh well, you lose money. You lose 100%. There is no, you can't claim any capital loss against taxes because it's tax-free. When money went into your RSP, it went in before tax. So for me in Canada, it would have, if I put $100 in my RSP, I save $53 in tax. So if I lose $100, I really only lost $47 because I would have lost $53 anyways. But if I lose $100 in my TFSA, I lose $100 in my TFSA. So I don't really want a lot of risk in there. Current point in the rate hiking economic cycle, which do you think is better, ABR or agency? I like them equally. I have them both. I like them equally. Agency currently trading 9.50, dividend yield 15%, higher than the average return on the market. What do you think about buying agency? Yeah, I own it. I'm not selling it, and since I'm not selling it, it's the equivalent to saying I would buy it at this price if I'm not selling it at this price. Do you do any channel trading? Not in the way that you would think. I remember a video you did on DuPont, trading Clear Channel for a while. I recall you said you can sell puts on DuPont, but you really couldn't buy puts at the top of the channel because there wasn't much liquidity. Yeah, DuPont wasn't very good for that. But I do that with a lot. AT&T, Oxy was a good one, and I just sell puts at the bottom of the channel. And I do quite well. I'm hesitant to sell calls at the top of the channel. Hesitant to do that. So I guess I do channel trade, but you know, I don't buy, sell. I just really focus on selling puts. No more than 2% of your portfolio single stock, Buffett and Munger are known. Okay, I see where this is going. But they oftentimes look to take whole companies out. And they have positions that they keep for years and years. And they buy very few targets. After a lot of research, and they buy large enough positions that they do have some kind of influence in what's going on. They do have access to management that you don't have access to. Not only that, they do have an ecosystem in Berkshire Hathaway that does benefit the others. So there is a difference between what they're doing and what you're doing. You're not going to have that kind of size, that kind of influence. So you're going to want some kind of diversification because you're not going to have access to the same information. So yeah, I don't know that I would follow them on that. Some of the brokerage account worth less than $1 million. How do you feel about having a more concentrated portfolio, say 10-20% in single stocks? No, I wouldn't do it. If you're wrong on one, it's a big hit. If you're wrong on, let's say you have 10 stocks, each at 10%, and you're right on 6 and wrong on 4, that's a big hit, right? You got to play with stop losses in that case, and you're not going to be right 10 out of 10. So, not a big fan of that. Believe that long-term rates in the U.S. Treasury market will go back below 4%? Yep. Destined to happen at some point, either after inflation is beat or we enter a recession. Yep, I do believe that. And if so, how do we calculate what is the interest rate sensitivity of our assets? How do you do this for equities? Well, that's a regression. It could be complex or it could be simple. You could pick one key rate like the 10-year and see how sensitive your equity return has been to changes in the 10-year. Now, some of my holdings are much more sensitive to Fed news, but I don't know how to systematically analyze this. Yeah, it's a regression analysis, and I would say this. What incremental information do you think you're going to get out of that? I mean, if you're looking for duration exposure, it's bonds. Bonds will give you all the duration exposure you want. In equities, utilities will give you the duration exposure. I don't know that you're going to get valuable information, information that isn't subject to a whole bunch of other things going on, because if you're looking for its interest rate sensitivity, you're going to have to control for a whole bunch of other things. You're undertaking a more detailed, complex analysis of which the outcome, I would say, is for the retail investor incrementally uninteresting. Other than knowing, oh, I've got this sensitivity, what would you do, right? I think it's incrementally uninteresting. Can you explain how you would handle the short reversal on Tesla for educational purposes? What would you do if Tesla started climbing higher? Nothing. I wouldn't do anything. I've got till 245 before I have to worry about it. And it's not a matter if it starts climbing higher. It's got to do a lot to get to 245 by January, considering the weight that it's under right now. As a car company, let's strip out everything. As a car company, it's not worth what it's worth. It might be worth 30 billion as a car company. If that's all it did was cars, it is carrying the valuation it has because of its other businesses. Energy generation and storage, they're not making any money on that. If that's what you're valuing them at, also very, very low valuation. So everything is in automation and AI. Everything is in that. You have to believe in that future. The robo-taxi future is decades away. Decades away. Let me tell you that. You're looking 20 years, 30 years, because you need the infrastructure to be smart at the same time. You can't just have 1 million robo-taxis on the road with a whole bunch of non-connected vehicles running beside it. That it's almost impossible to get done, and regulators will be a hair trigger sensitive on any accident whatsoever. You're not getting it done. The insurance company's not coming along, the infrastructure's not there, and you don't have a critical mass of these cars on the road. So you have to believe in that in that future happening before any of that. You have to believe in that, because there's the valuation of Tesla. As a car company, it's not worth its valuation. I don't think it's going to happen. I think automation is going to happen. I think you'll have level 4, level 5 at some point in time, but that's decades away. I think level 2 will be very common, pretty much everywhere. I think you'll have level 3 in certain geofenced areas. Tesla could probably qualify for level 3 in certain areas at this point, but they're not interested in going to level 3 in certain areas. They're interested in going from level 2 to level 4 very quickly. So level 0 is nothing. Level 1 is either the acceleration, deceleration is being controlled, or the steering is being controlled, but not both. Level 2 is both are being controlled. Level 3 is you still have the driver behind the wheel, but the driver doesn't have to pay attention in certain areas. Level 4, the driver can sit in the back seat. Level 5, you can remove the steering wheel and the brake and acceleration pedals. So Cruise, Waymo, these are level 4s. Level 4 requires a whole lot of technology to get there. A whole lot of technology. Which means you're not really going to make a cheap car. Not at this point in time. Not for the technology that has to go in there. But it will get cheaper over time. Level 5 you can have in very, very restricted areas. So let's say on a corporate campus, you have a shuttle bus that brings people from the main campus to the research lab. But it's a very drawn out route. It has its own lane. There's nothing in the way. Then you can have a level 5 vehicle that does just that. But driving around the roads all over the place, that's not going to happen for decades. Level 4 is not going to happen for at least a decade, if not 2 decades, on a widespread basis like Tesla's promising. This idea of an army of robo-taxis out there, not going to happen. So most of its valuation is in something that I don't think is going to happen, which the shareholders really believe it's going to happen. But if you're invested in Tesla because it sells cars, you're missing the point of where the valuation is. It's not worth anything as a car company. Even Musk says that on the call. If you don't believe in our automated future, don't even invest. I agree with him. So I don't think it'll climb from, where are we now, low 170s to 245. I don't think it has the rabbit in the hat to pull out that cements the case that this is going to happen. I think it'll be good at press releases. I think it'll be good at making announcements. I think it'll be good at saying it's just around the corner. It's just around the corner. If you pay $8,000 for FSD on your car, you'll turn it into a robo-taxi in anytime soon now. I think they'll play that route, but I don't see 245. So I'm not going to do anything. I've heard you cover this topic before. You should be able to talk about financial events and other topics in finance. Sports fans know everything. Correct. Studying for L2. Seems like I have a grasp on the concepts. When it comes to job interviews, it's difficult to communicate my knowledge and display competency. You may be trying too hard to come up with a perfect answer. I was observing the way you're able to communicate so smoothly and handling live Q&As. Is this something that comes with time? Yes, it does. I can comprehend the ideas, but putting together all these different ideas and knowledge in my brain to concisely handle certain questions just stumps me sometimes. Stick with what you know. Just talk about what you know and talk about what you're comfortable with, and get comfortable with, I really don't know, or in my opinion, or I think, it's okay to say you don't know. Somebody asks, what do you think about, the Indian stock exchange? I don't know. I know nothing about it. I say that about Canada all the time. What do you think about Canadian data, economic data? I don't know. Beats the hell out of me. I don't even pay attention to it. Even when I was living in Canada, I couldn't tell you what any of the data was. It's okay to say you don't know. Stick with what you know. And you get better at it by talking about it. You just get better at it by talking about it. So find a group of people who like to talk about the market and talk to them about it. What areas would you recommend practicing talking about so I'm better able to display my knowledge? Well, the areas that you are that you are knowledgeable about. There's just so many conflicting opinions and views regarding the outlook. That's what makes a market. That's never going to change. That's never going to change, and that's why you can fit in, because there are so many conflicting opinions. It's what is your opinion and what is it based on? To say, oh, I think people will do this. Well, why do you think people will do this? What basis do you have for that? What evidence do you have for that? So, just make sure you have a basis for what you're saying. But yeah, there are so many conflicting opinions. Who's going to know? Nobody knows who's right or wrong. Only time will tell who the winners are. I have a broad understanding of what's going on, but kind of feel a bit of imposter syndrome when discussing it. Almost everybody who is knowledgeable understands the limitation of what they know. Everybody does who's knowledgeable. It's the ones who are not knowledgeable who don't suffer from that because they think they know it all. You know that expression, a little knowledge is a dangerous thing? So they know a little bit about something and then they think they know it all. Whereas when you learn about something, you start to realize how much you don't know about it. So you're always aware of that big amount that you don't know, that at any moment in time, a real expert can come by and say, well, hang on a second, you're wrong on this, this, and this. Well, everyone suffers from that. Everyone who's aware of it suffers from that. But that's a good thing. What it means is that you are aware of all the things you don't know. The moment you are introduced to a topic and you say, oh, I get it, I know it all. The moment you say that, you're going to make a fool of yourself. Right? What practical advice would you recommend to help with this issue? Well, I think I gave enough there. Thoughts on Bill C-63 in Canada? It is concerning we are moving away from free speech. No, we're not. No, that's not what Bill C-63 is. I'm no fan of the Liberal government. I'll tell you that much. However, you got to call out misinformation when you hear it, and the right is sort of, making a field day on this. And it is not what they say. I wish it was what they say. I wish the right was correct. when they talk about Bill C-63 taking away free speech. I wish it were true, because then we could walk into every sociology department in every university in Canada and arrest every single teacher in gender studies, queer studies, critical race theory. Every one of them we could arrest, because the hate that they put out there against white, the hate they put out there against straight, the hate they put out there against men, and it is driven by hate. We could arrest them all and put them in prison. I wish it were true, but alas, it's not. They can keep spewing their hate. In the bill, if you read it, in the second part of the bill, because I've read it, the second part, it says, this bill does not cover speech that hurts people's feelings, other people find offensive, any of that stuff. You are free to offend anybody you want. You are free to hurt anybody's feelings. You are free to say anything you want. You can say there are only two genders, and if you think there are more, you're the one with the mental issues, not the rest of us. You're the one that needs. You can say that. Now, I'm just throwing out an example of what you can say. Look what I just said. You can say that. You won't get arrested. Oh, somebody may take offense at it and somebody may not like it. And maybe they'll call the police and the police will say, you're kidding me, right? Did they hit you? Did they assault you in any way? And if the person said, well, they said this hateful thing. Well, you may have hate what they said, but it does not qualify under the law. Under BCIL C-63, it doesn't qualify. Here's where it does qualify. Let's say you see somebody punch a woman in the face. A man punches a woman in the face. And you find out later on that they had an argument. He got upset. He didn't control his emotions very well and he hit her. Well, that's assault. That is assault. That's a crime. You've committed a crime and there's going to be penalties for that, right? You can go to court and argue the mitigating circumstances, but there's going to be a penalty for that. But let's say you found out that that man punched that woman for no other reason than he hates women. Well, suddenly he's no longer a threat to just that woman that he was in an argument with. He's now a threat to all women. Do you get that? He punched her purely because he hated women. That is what Bill C-63 involves, is that if you commit a crime with hate, in other words, if you hate someone and you're committing a crime, the penalty should be worse. And I agree. If you punched a woman for no other reason than she's a woman, then you're a threat to every single woman out there. But if you punched a woman because she triggered you, you got in an argument, you didn't handle your emotions, you punched her, you're not a threat to every other woman out there. You're just a threat to that one. It's still a crime, but you're not a threat to society. But if you're doing something because you hate, you're a threat to society. That's what it covers. So it has this layer of hate on it, that if in the commission of a crime, your motivation for committing that crime was driven by hate for something, hate for a skin pigmentation, hate for a group of people, then the penalty will be worse. But if you're just running off at the mouth in public and committing no crime, you're free to insult anybody you want. You're free to express any opinion you want. It doesn't matter if somebody says, oh, that's offensive. It doesn't matter. It doesn't matter. You can tell racial jokes if you want, out in public, and no matter who finds it offensive, it's not a crime. So, no, it doesn't move away from free speech. I find that it is actually a pretty good law. And just think of the example that I gave you, right? Making a sector study overview of the cyber defense industry be interesting for you at all? Yeah, probably. But the problem I would see right away is where am I going to get data from? Where am I going to get information? It seems fairly recent. I'm probably not going to get the best information. Rather niche, but given the prevalence of hacking these days, seems like the area could have potential at first glance. Yeah. But again, because it's so new, I wouldn't know where to get information. I wouldn't know where to start. Most of these companies are probably going to be very reluctant to share a lot of information, right? Because, well, look what they're doing. So it's getting the information that's going to be the tricky part. L1 QM module going through LM2. The video isn't working. Could you help? Nope. I'm not tech support, and I don't own the company. So, two things: it's not my business, and I'm not tech support. Still planning to do Fed balance sheet video? Yep, I am. It's not as interesting as the first two. With the first two, you've got a lot. The balance sheet one is more accounting based. Consider doing Forex option tutorial video in the applied series. I don't know why you would want to use options on Forex. Options on futures? Yeah, I've done that. Selling puts on futures on CAD, I've done that. But options on the Forex, they're illiquid, they're European, impossible to get out of once you're in. There's almost no volume on them whatsoever. No. And I think their underlyings are like $10,000 or $15,000. It's like they're uninteresting. High conviction. There's an opportunity in the small modular reactor niche. That's pretty specific. Small modular reactor. That's nuclear. Compare my conviction level towards the Canadian REITs. Small portfolio, 150 contribution. What would be the things to do and not do in building a sizable position? Well, what's a sizable position when you have 10K? If you're saying, well, I want the whole thing in it, well, I mean, I don't know that there's anything I can say to do or not do in building a sizable position with a small amount of money. Not a clue. I don't even know who builds those. GE? I don't even know if they're deployed in the world. Are they? Are they in use? I mean, other than in, maybe Russia, China, would they be in use? I don't know. Getting close to retirement, start investing high quality Canadian preferred shares. What are your thoughts on preferreds? Yeah, I like them, especially for retirement, because now you're not getting interest income, you're getting dividend income in a bond-like security. Most preferred shares in Canada are issued by either utilities or the banks. So they're good. I think they're good. Yeah, I like them. What are your thoughts regarding XLU, XLP, both outperforming QQQ and SPY over last month? Well, they probably performed because they just weren't as weak as the other two. I mean, that's just the last month. Because they're safer, so they would have fallen by less. Can XLU be a reliable indicator of where smart money flocks to safety? I don't know if money flocked to XLU in as much as money didn't leave XLU. I don't know that it went to XLU. I don't know that they would do that. I think Treasury is the place to be. Increasing talk lately regarding Japan's intervention to protect the yen. Yeah, but it's not working out very well. I think Tuesday night, Ueda tried it, just with the open mouth intervention to see if he could talk it down, and the market was having none of it. The yen weakened on what he was saying because it's like, oh, you're all talk, no action. Here we go. I don't know that the BOJ, or the Ministry of Finance sees intervention as anything other than really short term these days, and short term means a couple of days, maybe even a couple of hours. So I think they're less likely to do it, and I think they're more likely to wait and say, well, the U.S. has to cut rates at some point. That's what's going to strengthen the yen because the interest rate differential will decrease. They're not about to raise interest rates to prop up the yen, given the sheer size of the debt that Japan has. And they have to keep rolling over that debt and issuing new debt. They're just not going to do that. How is a bull flattener when the belly outperformed the long end? Well, bull means rates are dropping. And flattener means that the curve is, well, we're inverted, becoming more inverted. So you just simply look at the spread from the 2 to the 10. The 2 to the 10 spread increased. Even if it increased 1 basis point, that is a flattener. Or sorry, decreased. The 2 to the 10 decreased because it's negative. This argument on excess government debt was brought up last year. The argument was the point was overblown. Last year it was overblown. Let's think about what happened over the course of the year. The Fed owns most of that debt. The Fed does not own most of that debt. The interest expense the Treasury pays goes back to the Treasury. Not anymore. Fed and Treasury. U.S. Treasury here, interest, and then the Fed just gives it back. But not anymore. The Fed's net income is less than zero. So it receives interest payments from the Treasury, and then it pays out interest on its reserves, right? Because it works in an ample reserves regime now, so it pays interest on reserves. So it's losing money, so nothing flows back to the Treasury. Over the course of the year, $720 billion has run off from the Fed balance sheet, shifting that $720 billion to the public because the Treasury issues new bonds to retire old bonds. Fed didn't buy $720 billion, so the public has to pick that up. So you had a situation where a year ago you were somewhere around $23 billion once you eliminated the SOMA. But in the past year, $720 billion runoff. You have the Fed losing money, and you have $4 trillion that was added to the deficit over the course of the last year, plus the projected deficit and the increase in issuance from the Treasury because you raised the debt ceiling, right? So it's more like 29 trillion. I shouldn't have said billion. 29 trillion. You went from 23 trillion to 29 trillion over the course of the year with no money flowing back to the Treasury. And on this 29 trillion, you've increased the interest rate that you pay on that 29 trillion as a whole. So not only have you increased the amount of debt, you've increased the cost on the amount of debt with nothing flowing back to the Treasury and no end in sight. That's the problem. No end in sight. So now it's a problem. Who could have foreseen that another year of rapid increase in the debt? And I think that it accelerates from here. I think it just because, again, you have $1 trillion in interest expense expected over the next 12 months. That simply just add that to the debt right now. And then whatever crazy ideas the government wants to do. You get a Trump administration next year, he's going to cut taxes, which is going to make the deficit even worse and the debt even higher. So I don't see an end to this. I don't see an end to it. It is gone from, you know what, this is not a problem, to, okay, I didn't think you would do that. You had a chance to fix this. You had inflation. Usually with inflation, you get to inflate away the debt. You did not. You exceeded. You made it even worse. I wouldn't have thought you had done that, but you did. So now it's a different story a year later, right? You can think about it this way. Last year, your credit limit on your credit card was $10,000. You were carrying a $4,000 balance, and you had a job. And this year, you're at $10,000 limit, and you have no job. This is not a problem. This is a problem. And that's where we are. When I say job, no job, it's because the Treasury's not getting any of that money back. Kick Peter Schiff to the curb, sound like a broken clock. Now hearing you use his exact same view on rates and monetary policy and long miners with gold busting out has me sending my apologies to poor Schiffy. Well, this guy has been saying the same thing for how long? You're bound to be right at some point. If I say World War III, from here till I die, at some point I may be right. And then all the news channels are going to want to interview me saying, you've been calling for this for some time, haven't you? Yes, I have. Yes, I have. Well, if you scream the same thing every single day, at some point you'll be right, especially in cycles. You'll be right once a cycle. The key is to be right in time, right? So last year, no, it really wasn't a big deal. Much like you having a $10,000 limit, $4,000 debt, and you had a job, I would look at it and say, nah, that's not really It's not really, I don't know that I would be, screaming fire at this point in time, but conditions change over time, so you have to be willing to change your mind. But when you don't change your mind, as conditions change and you keep saying the same thing, then that can be ignored. Let's see if I can get that back down there. I increase the size of that. Let me just file new. Let's just get a new page on there. There we go. Have you ever considered using EDV instead of a TLT? Nope. Confused about shorting options. Oh, I already answered this one. Already answered that. Can you explain why having a short position against your long positions is better than just reducing long exposure? Why would I want to reduce long exposure? I don't know why I would want to do that. I'll pass on that one. Stephanie Kelton and MMT seem to be back in the spotlight again, with deficits as far as the eye can see. Hasn't the U.S. already adopted this theory? Pretty much, yeah. If inflation is a disciplining factor, do you think MMT could ever work? Inflation is not a disciplining factor. And the problem with MMT is it doesn't account for the inevitable big jumps in spending that are going to happen in recessions. And it doesn't account for the permission that you give politicians when you give them cover. That you say, well, listen, you can do this. As soon as you tell a politician they can do that with the budget, they'll do this. So it doesn't work. And I want you to think it through very clearly. You can deficit spend for as long as you want, and it's not going to do anything. Does that even sound like something that's remotely true? That would only work if your nominal GDP was growing faster than the amount of debt that you were taking on, or growing at the same rate as the amount of debt that you were taking on, so you continue to afford it. It would only work if you had an interest rate that was well behaved and constant over time. It would only work if you never had recessions, and it would only work if you respected the limit on the deficit each year. Do you have any of those conditions? No, it is a theory so crazy only an academic could hold it. It's curious in which you already answered that. Apple announced 110 billion share repurchases. The company added almost 200 billion in market cap. Should share buybacks impact market cap? Yeah, they should impact market cap, but in the opposite direction. So whenever you are trying to figure something out, just always go with an extreme example. Let's take a company with $2 trillion, pure cash, and it's selling at its net asset value. It should have a market cap of $2 trillion. And let's say it's going to buy back 100 billion of shares. So it'll have 1.9 trillion of cash. Its market cap should be 1.9 trillion, right? That's an extreme example. So that is basically what we should see if a company's trading at its book value. We should see its market cap drop. But a company with a franchise meaning it has some kind of revenue earnings machine, the buyback could send a signal. Is that, well, if management is buying back its own stock instead of investing in other assets, it must see its own stock as the single best investment it can make. So, and since it's management that's doing it, they know what's going on. They see all the numbers. They must have some inside information. Well, they do have inside information, and if they're buying their own stock, it must be a screaming buy. And that's why it goes up in price, is because of the belief that if the company is doing it and they can see everything, they have great information. If they're buying back their own stock, it must send a message, or there's a message in there that they can see no better opportunity but to buy back their own stock. It must be the highest value investment they can make. Otherwise, they'd make other investments, right? It's behavior that drives up the price, not pure financial mathematics. Congratulations on the timing of exit, great nation. Massive alternative minimum tax increase January 24th. I thought that was just a proposal. I didn't know that it actually did happen. It was expected to go from 15% to 20.5%, I think. I thought that was just a proposal, but if it did happen, oh well. I mean, what did you expect? Cap gains changes. Has that been voted on yet? That's supposed to be put forward in a separate bill to be voted on. I don't know if it has been done yet. And now an additional massive exit tax being discussed by our glorious leaders. Well, I said this, starting last year, is if you are successful in a developed country like Canada and the US, given the level of debt that they have, if you're successful, you don't get to keep that. It's just a matter of time before they come and take it from you, because they're not going to take it from somebody who doesn't have it. They got to take it from somebody who does have it. You will pay a disproportionate amount of that debt. And the beautiful thing is this. As they take more from you, it'll give them license to spend even more. So you'll never actually pay down the debt. So if you are successful and you have a nice pile of savings and capital, you don't get to keep that. If you think, well, I'll just pass it on to my kids when I die, they're not going to get it either. It wouldn't surprise me if you had estate taxes as high as 90% sometime in the future. You got to pay for this debt. You got to pay for the debt. You got to pay for it. And only successful people will be able to pay for it, and successful people will pay for it. So whatever you have, don't name it, right? It's think of having cattle. The last thing you want to do is start naming your cattle, because you got to kill it. Don't name it, because you're going to lose it. You're going to lose all of it. You don't get to keep it. You're just holding on to it for a while. You don't get to keep any of that stuff. For a beginner level fixed income student, can you please help understand what does it mean, increase or reduce duration? Increased duration means you're buying bonds. Reduced duration means you're selling bonds. Also, how's that achieved in the portfolio? Just did. Understanding of duration is that it's a percentage change in the portfolio by a percentage change in interest rate. That's right. It is. So you want to get rid of things that change as interest rates change. And that's bonds. Duration, we're talking bonds. Beta, we're talking stocks. What's a fair tax rate? 40%. 40% and piss off. Leave me alone. Piss off. There's my 40% of my income. Now leave me alone. But in Canada, in Ontario, the top rate's 53.5, and then you get 46.5. Now, if you go out and spend that on luxury items, you'll pay a 33% sales tax. And just because you're making more than $250,000 a year, instead of 50% of your capital gains taxable, it's now 66% of your capital gains that are taxable. And just in case you have depreciation and other expenses that get your taxes down that other people can use, since you're successful, you don't get that. There is an alternative minimum tax that you have to pay. You're getting me here, you're getting me here, you're getting me here, you're getting me here. Come on, man. 40% and piss off. Let me spend my money the way I want to spend my money, and I'll give you 40% of every dollar that I make. It's yours. Here you go. Thank you. But you want 53% of every dollar. Then when I spend that dollar, you want 33% of the purchase price. And then when I make money, you want to say, oh, other people get a lower rate, but not you. And then when I have the same deductions other people have, you say, okay, well, your taxes would be this, but no, there's a certain minimum we want you to pay that other people aren't subject to because you're so successful. So you're getting me everywhere, right? You're getting me everywhere. So pick one, for Christ's sake, pick one. Just pick one of them. But you can't keep saying a little bit more here and a little bit more there and a little bit more here, because all of these little bits add up to a significant amount every single year. So, yeah, it's completely unfair. It's different laws for me if I were still in Canada, because you're allowed certain deductions, and because you make under a certain amount of money, you have certain tax laws. Because I make more, I don't get the same benefits. I get less of a benefit than you. At a higher tax rate, with a higher sales tax, with a higher inclusion rate. It's all of these little things that add up to massive unfairness. 40% and piss off. Get rid of this. If it's 13% for everyone, then it's 13% for everyone. Thank you. If it's 50%, it's 50% for everyone. Thank you. And if you offer tax credits and tax deductions, don't suddenly say, not for you though, not for you. Okay? Give me one tax rate, 40%, which is pretty high. I would never have left. I would never have left. I would never have complained. I would have said, okay, this is fair. It's high, but I'll live with it. But it's not fair. Would you consider sticking to market and economic commentary? I think I do. I understand it often ties into politics, tax policy, but you're constantly repeating the politicians are idiots narrative. I wish I didn't have to, but they are. Stance is well established. Yeah, but I can't count on the same people listening to me all the time. That every week there are new people, new listeners, so, the conversation takes me where it takes me. But I get it. I'll start talking about lawyers. I don't think I've ever mentioned my hate for lawyers. Maybe I'll talk about technical analysis. I don't think I've ever mentioned that either. Are you doing synthetics on car? Nope. Would you advise against this because of the high interest rates? No, just not doing it. You mentioned ABR is navigating a tough environment. Can you talk about? Oh, I already did that. And there we are.